I now recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. Professor Girding, in your testimony, you identify CLOs as, quote, close cousins of mortgage-related CDOs that were at the heart of the global financial crisis. From 1993 to 2018, do you know how many principal impairments were recorded for the 9,181 tranches issued by U.S. CLOs over those 26 years?
I don't have that data.
Well, I can tell you what the answer is. It's 53. 53 impairments out of 9,181, or 0.58%, and that includes defaults during the period of the worst financial crisis since the Great Depression. Mr. Vasicich, you have attempted to conflate CLOs with other very different asset classes that were actually at the heart of the 2008 financial crisis, namely subprime residential mortgage-backed securities, credit default swaps, and other squared structures like CDOs, collateralized debt obligations. Do you know how many AAA or AA rated CLO tranches have defaulted over the last 26 years?
I don't have that data.
The answer is zero.
Yeah.
Zero. Not a single default, including during the worst financial crisis since the Great Depression. And the reason why CLO debt securities have performed so well, and by the way, you're concerned about bank investment in CLOs, they only invest in AAA and AA tranches. The reason why CLO debt securities have performed so well historically, even in times of economic distress, is very simple. CLOs bear absolutely no resemblance to the toxic CDOs that preceded the financial crisis. In fact, CLOs performed very well during the crisis, and this is because CLOs are straightforward, long-only investment funds professionally managed by SEC-registered investment advisors that typically hold 90% of their assets in senior secured commercial and industrial loans. These are not residential mortgage-backed securities, subprime, no doc loans. These are first lien senior secured industrial and commercial loans that in well-known American companies with high levels of collateral. Mr. Nini, can you discuss the diversification of CLOs and the alignment of interest between CLO managers and CLO investors that differentiate CLOs from CDOs?
Sure. The leveraged loan market spans a wide set of firms across many, many different industries and locations. This provides lots of ability for CLOs to invest in a very broadly diversified set of loans, and they all do. They all have rules that require them to do so, and they hold very well diversified portfolios. The managers of the CLOs who are charged with selecting those loans have compensation which looks very much like an equity exposure in the CLO. This puts them on the hook for risk if things go bad. Their compensation falls. The obvious intention of this is to give them incentive to do a good job.
Right. In fact, CLOs are actively managed, and there is a perfect alignment of interest between the CLO manager and the CLO investors because the CLO manager is paid only after the note holders are paid. Finally, let me just make this point. And by the way, there is diversification. Typically, no more than 3% of their portfolios in the loans are in any single borrower and no more than 15% in any single industry sector. That is fundamentally different than mortgage-backed securities where there was no visibility, number one. But number two, they were all concentrated in a single residential real estate market. Finally, this is an important point. Because CLOs are long-run, non-mark-to-market investors, they are term structures, and that means they represent locked-up money that can withstand and, in fact, provide liquidity in stress market environments. So in a downturn, CLOs actually stabilize the market by acting as a buyer when the rest of the market is looking to sell. It is problematic that nobody understands this, it seems, in this room, except for Mr. Nini. CLOs are long-term capital. They're not subject to short-term redemptions or outflows. And in this regard, CLOs provide a vital source of liquidity in a downturn. This is exactly the kind of structure that policymakers should want. So I don't get it. These are high-performing. They are liquidity providers in a downturn. They represent locked-up, the long-term, non-mark-to-market investors. And why does this matter? Because 72% of all American companies are non-investment grade. Leveraged loans provide $1.7 trillion in financing to American companies, and most of the commercial credit in the market comes from non-banks. Because Dodd-Frank era regulation is limiting the amount of leveraged loans a bank can take on, the capacity of non-banks to fill the liquidity gap becomes that much more important. If non-bank lenders become constrained, then guess what? Funding costs will go up. Funding costs go up, bankruptcies happen. bankruptcies happened, there are less jobs, there are lower wages. That is not good for financial stability. The over-regulation of CLOs would be an impediment to financial stability. And my time has expired. I've got more questions, but my time has expired, and I yield back.
Thank you, and I yield the balance of my time to Mr. Barr.
I thank my friend from Colorado. And Mr. Nini, let me follow up on a point that I was making towards the end of my questions, and that is the unique characteristic of CLOs in that they are long-term, non-mark-to-market investors. They represent non-mark-to-market investors. Can you comment on how that structure could provide liquidity in a downturn, and in that sense provide a stabilizing impact on the market?
Yes, it's very important to note that the collateralized loan obligations, they borrow money at maturities longer than the maturities of the loans that they hold. This means that they're rarely going to be forced to repay some outstanding debt. During the end of 2018, when there was some volatility in markets, CLOs were buyers of loans at low prices, playing the exact role that you point to. The fact that they can't experience a run does have the potential that they can be a stabilizing force during.
And does this explain why CLOs performed so well during the financial crisis?
I believe it's one of the factors. There were some mark-to-market CLOs that existed pre-crisis. Those have gone away and don't exist
don't
anymore
exist
because
anymore.
they don't make sense.
I yield back.
Mr. Chairman, I yield my time to my colleague, Mr. Barr.
Thank you. Appreciate my friend from Texas yielding. Ms. Ivashina, I wanted to explore this issue, which I think is a very important one you raised about lack of visibility, because of course that was a major problem during the financial crisis, the lack of visibility with respect to RMBS and originate-distribute, the originate-distribute model. That's not what we have here. We have, this is not originate-distribute. These are professionally managed, and there's a high level of visibility, unless I'm missing something, in terms of these being senior secured commercial industrial loans into companies that provide financial audited reports to these professional managers, and they're not squared structures. There's no CDOs. There's no credit default swaps on the other end. They're just long term. So why do you say there's a lack of visibility, or relatively speaking, wouldn't you concede there's greater visibility into these products than those subprime RMBS?
On the one hand, the fundamentals are more observable of the company. But on the other hand, for each loan, we have to understand 200 pages of very complicated legal language with not only covenant lightness, which concerns very small fraction of the contract, but basket carve-outs and other forms of erosion on each one of the negative covenants. That you would need to do for 100 loans that sit in a CLO, and for each of the investors in investment grade to understand that. That's the similarity with mortgage market.
But I'd like to yield some additional time to Mr. Barr, my friend and colleague from Kentucky.
Thank you, Mr. Budd. My friend from Georgia asked, I think, an important question to Mr. Nini about the relative size of the U.S. leveraged loan market compared to the investment-grade bond market, the mortgage debt market, the overall fixed income market. And the numbers, just to share for the record, according to the securities industry, is that, as you said, 1.7, 1.8 trillion is the leveraged loans outstanding today. My understanding is that the entire U.S. fixed income market is around 42 trillion. So in terms of the relative size compared to the overall fixed income market, I think that's an important contextual fact that we need to keep in mind. Another point is that in the last quarter of 2018, the FANG stocks, 5 stocks, Facebook, Apple, Amazon, Netflix, and Google, during the volatility of December, lost over $630 billion in market cap, which obviously led to short-term losses and significant losses for their investors. But it did not spread across the entire financial system. And I think it's important to note that the losses in these 5 stocks in that one quarter amounts to more than 60% of the entire leveraged loan market. So, look, I don't think anybody's going to deny that there's risk in leveraged lending. Of course there's risk in leveraged lending. That's the whole point. And I don't think many people are going to deny that credit risk is actually increasing either. I think the issue here for the purposes of this hearing is whether or not that increased risk presents a systemic issue. And the point is, it's just not that significant it's an important part of the financing of great American job-producing companies. It creates dynamism in our economy, creates wages and jobs. It forestalls bankruptcies. It helps create efficiencies, but it is a relatively small slice of the entire U.S. economy from a systemic risk standpoint. I think that's an important point. Final point/question to anyone who wants to answer this. I have to note and observe that many of our colleagues who are expressing skepticism of leverage lending here today are the very same members of Congress who are calling for a rollback of tax reform, corporate tax reform. They're the same colleagues who are calling for a rollback of the limitations on corporate interest deductibility. They're the same members of Congress who are calling for an increase in corporate income tax rates, which for leveraged but profitable companies doesn't seem to be like a very good idea for financial stability. I don't understand why we would be, if we are concerned about levered companies, why we would want to go back to the old tax code that incentivized less profit and more leverage. And I'd be happy to invite anyone to comment on that. Professor Gerning, I think you want to speak to that.
So the interest deduction for debt, it actually incentivizes more leverage by companies, both financial institutions and non-financial institutions. So I don't see that position as inconsistent at all.
So here's my question. Why would we want to make it harder on levered companies by increasing their taxes to the extent they have taxable liability? And I get it. Some highly levered companies may not have profits, but to the most of these companies have taxable profit, corporate profit. They may be levered, but they have. Why would we want to increase taxes? If we're concerned about leverage in the system, why would we want to make it harder on levered companies?
Because long-term, I think we should be reducing our dependence on debt. There are other capital markets, like equity markets, that companies can access to fund themselves. Long-term excessive reliance on debt, particularly debt by financial institutions, is destabilizing.
Well, making it harder on
Gentleman's
levered
time has
companies is not a good
expired.
idea. I yield back.